You have money. It's sitting in your bank account. You can see it on the screen. The number is right there. The balance is correct. Everything checks out, but you can't take it out. Not because it's gone. Not because you did anything wrong. You just can't. The money is there. The system is working, and you still can't touch it. The bank is open. The doors are unlocked. The tellers are smiling. Your money is simply not yours. Not right now. Maybe not ever again. This is not a doomsday scenario. This is not fiction. This happened to real people in a real country at the beginning of the 21st century. And that is exactly why it matters. Because the system didn't announce its failure in advance. It just, one morning, stopped working the way everyone assumed it worked. Most people think about a bank the same way. You put your money in, the bank holds it like a vault, like a safe. You worked for it, you saved it, and you brought it somewhere trustworthy. There's a system there. There's a government behind it. There's deposit insurance. That feeling of ownership over your own savings is one of the most fundamental things a person can believe. You don't question it. Money in the bank is money in your pocket, just safer. That belief is the foundation of the system. And it is wrong. But here's what the bank actually does with your money the moment you walk out the door. It lends it out. Not steals it, lends it. Legally, systematically. Your money becomes someone else's loan. That loan becomes someone else's money. That money comes back to the bank and gets lent out again. The same dollar, the same peso, the same euro exists in multiple places at once. This is called fractional reserve banking, and it is the foundation of the entire modern financial system. The system works as long as not everyone asks for their money at the same time, because if they do, the money isn't there. When everything is quiet, the mechanism works. People deposit, people withdraw, no one shows up, demanding everything at once. The system holds together not because the money is there, but because access is rarely tested all at once. You are not storing money in a bank. You are lending money to a bank. And lending means you don't control access. You only control the expectation of access. Legally, you are a creditor, and the bank is your debtor. And a debtor can fail to pay, can restructure, can pay back in a different currency than the one it borrowed. The difference between a vault and a debtor is everything, and most people never think about it until the moment it matters. Imagine it's December 2001. You live in Buenos Aires. You're 40 years old. You have savings, maybe $10,000. You kept them in dollars, specifically because the peso was unstable and the dollar felt solid. Those 10,000 are for emergencies, for your children's education, for the unexpected. It's Friday, a normal day. You hear on the radio that the government will make an announcement. Politicians always announce something. You go home, have dinner, go to sleep. Saturday morning, December 1st, 2001. You open the newspaper. Corralito. The Argentine government has just frozen all bank accounts. Cash withdrawals are limited to 250 pesos per week. International transfers banned. Deposits were effectively frozen, with no clear timeline for when access would be restored. Your $10,000 are still there. You can see them. You just can't take them out. Nothing was taken on paper. And yet, everything changed. 250 pesos a week, roughly $250. The money exists. Access doesn't. 1,000 a month. You have a family. You have rent. You have suppliers. And the question that enters your mind, what happens if 90 days from now, nothing has changed? To understand how a country reaches this point, you need to go back 10 years. In the early 1990s, Argentina was living through hyperinflation. Prices were rising by thousands of percent per year. Money lost its value faster than people could spend it. In 1991, the government made a decision that seemed brilliant. A convertibility law pegged 1 Argentine peso to $1, fixed by law, not by recommendation, not by agreement, by law. It worked. Inflation collapsed. The economy stabilized. Argentina became the Latin American economic miracle. People trusted the peso again. Life got better. But behind that stability, a structural problem was building. A fixed exchange rate means you cannot devalue your currency when the economy weakens. You cannot print money when markets need support. You are entirely dependent on dollars coming in from outside, from exports, from loans, from foreign investors. While the global economy grew, everything held. When crises hit Asia, then Russia, then Brazil, dollars started leaving Argentina. Reserves shrank. The government kept borrowing to maintain the peg. By 2001, Argentina's debt was approximately $140 billion. At that point, the outcome was no longer uncertain. It was only delayed. The country could no longer service it. The system was unraveling. Not suddenly, then all at once, like a dam with a crack. From the outside, it's standing. From the inside, it's already gone. Those who understood began quietly moving money abroad. Billions were leaving every week. That is exactly why the government introduced the Corralito, to stop the outflow, to force the money to stay inside. But money is not water. You can't just close a tap and say stay. The word Corralito means small enclosure, a little pen, the kind you keep animals in. The word wasn't invented by officials. It was invented by Argentines themselves. Here is how the freeze mechanism works. When a government realizes the banking system cannot cover all deposits, it faces a choice: let the banks collapse, or restrict access so they don't collapse right now. The second option is always chosen first, because bank collapse is political death, because regulators and bankers are connected by 1,000 invisible threads, because temporary restrictions always sound softer than the bank has failed. And temporary, in the language of governments under pressure, rarely means what the dictionary says it does. The restrictions are introduced for 90 days, then extended again. Then the government announces that dollar deposits will be converted to pesos, not at the market rate, but at a rate the government sets unilaterally. The rules shift in the night, and by morning, your savings are denominated in something different than what you put in. In 2002, Argentina announced Pesification. All dollar deposits were converted at 1.4 pesos per dollar. A few months later, the market rate was nearly 4 pesos per dollar. A person who had $10,000 received pesos worth roughly $3,500 at market value. They lost 65% of their savings, not because of a bad investment, because the government changed the rules in the middle of the game. The money didn't disappear. The number on the account changed, and that was enough. On the street level, a different story was unfolding. Small businesses stopped accepting card payments. Transferring money between accounts was impossible, and cash was scarce. A hardware store owner couldn't pay his supplier. The supplier couldn't pay the manufacturer. The chain broke at every link, not from lack of demand, not from lack of product, simply from the inability to move money from one place to another. Not because the system disappeared, because it stopped moving. People lined up at ATMs from 5 in the morning to withdraw their legal 250 pesos before the machine ran dry. Sometimes it was empty by 7. People did the math on their kitchen tables: how many weeks of groceries, how many months of rent, how long before the limit runs out, and there's nothing left to calculate with. Then, something nobody expected appeared: barter networks, mutual exchange clubs called Clubs del Truque. By the end of 2002, an estimated 2 to 6 million people were participating. A dentist traded teeth for eggs and flour. A university professor gave math lessons in exchange for vegetables. Accountants traded tax advice for clothing. The system humanity had spent centuries building: monetary exchange, universal equivalent, simply stopped working for millions of people. Not in a war, not in a natural disaster. In a functioning country, with electricity, with internet, with stores full of goods, just no way to pay for them. On December 20th, the government declared a state of emergency. The squares filled not with activists, but with ordinary middle-class people who had played by the rules their whole lives. They came out with pots and pans and simply banged them. The cacerolazos. On December 21st, President de la Rua was evacuated from the presidential palace by helicopter. Over the next 2 weeks, Argentina went through 5 presidents. Then, the largest sovereign default in history at that time, $93 billion. Then, Pesification. Each step a consequence of the one before. The freeze caused panic. Panic caused political collapse. Collapse caused default. Default caused Pesification. None of these steps was inevitable on its own, but each one made the next almost unavoidable. Argentina 2001 is not an exception. It is one of the most vivid cases, but far from the only one. Greece 2015. The banks didn't fail immediately. Access did. 3 weeks of withdrawal. Limits €60 per day. Banks closed. Cards worked only inside the country. People stood in the same lines at ATMs as Argentines had 14 years before. A different country, a different decade, the same queue, the same helpless arithmetic of how long your cash will last. Cyprus 2013. The money didn't disappear. It changed form without permission. Depositors with accounts above €100,000 were forced to participate in rescuing the bank. Their savings partially converted into bank shares they never asked for. It was called a haircut, a polite word for confiscation. In practice, it meant if the system needs your money, the system takes it. The European Union signed off on it. The IMF approved it. It happened inside one of the most regulated financial environments in the world. The United States, 1933. The rules changed. And ownership changed with them. Roosevelt declared a bank holiday. All banks closed for a week. Then citizens were ordered to surrender their gold at a fixed government price. Refusal meant criminal prosecution. A year later, the government raised the official price of gold by 40%. Those who obeyed the law had already lost. Those who kept their gold illegally came out ahead. The system had rewarded the people who didn't trust it. Iceland, 2008. 3 of the country's largest banks collapsed within days. Currency restrictions remained for nearly a decade. An entire generation of Icelanders discovered that the financial infrastructure around them could simply stop functioning, not in theory, in practice, on an ordinary Tuesday. Different countries, different eras, different circumstances, the same mechanism, the same ending. The structure doesn't change. The system comes under pressure. The government introduces restrictions, and depositors discover that access to their money is not a right. It is a privilege that can be revoked. This is not a conspiracy theory. This is the documented history of the 20th and 21st century, And in none of these cases did people think it was possible until it already had happened. Why does this keep repeating? Not because governments are malicious, but because the system is built this way. This is not a design flaw, it is the nature of the design itself. A fractional reserve banking system is by definition vulnerable to a bank run if everyone comes for their money at once. There is not enough. This is mathematics, not politics. The system functions on collective trust. The moment enough people stop trusting the mechanism that was invisible becomes catastrophically visible. A government that issues its own currency can always change its value. Devaluation, inflation, pesification, the names vary. The substance is the same. Your money nominally exists, but its purchasing power was reduced by a decision you did not make, in a meeting you were not invited to, at a time you were not warned about. And the most structural point of all, a system that can see your assets, can manage them. A bank account is completely visible. Every transaction recorded, every balance known. It doesn't. The system knows exactly how much you have and can change the conditions of access at any moment it chooses. Visibility is vulnerability. If the system can see it, it can control it. If it can control it, it can restrict it. If the system can see your asset, it can freeze it, convert it, restrict it. This is the law of the system, not the exception to it. It doesn't require malicious intent. It only requires sufficient pressure, and sufficient pressure, in the history of the last 100 years, has arrived in every generation, in some country, somewhere. After the crisis, Argentines became one of the highest per capita holders of physical dollar cash in the world, not in accounts. Physically, at home, under mattresses, behind walls, in places the system cannot see. By various estimates, between $200 and $400 billion are stored in Argentina outside the banking system. This is not irrational behavior. This is not paranoia. This is a rational response to lived experience. People who survived the Corralito drew one conclusion that no economist had to explain to them: if you are not holding it, you are not holding it. The number on the screen is not the same thing as the thing itself. They learned that distinction in the worst possible classroom. Here is what remains after all of this. Not advice, not a strategy, a principle. Access is not ownership. You can see the number on the screen. You can receive statements. You can consider that money yours by habit, by law, by your contract with the bank. But if you cannot take it out right now, you do not own it. You own a promise. And promises are only as durable as the system backing them. A system that, under enough pressure, tends to protect itself before it protects you. The system works while it works, and when it stops, it doesn't fail. It reveals how it was always designed, and while it works, it is convenient, fast, and safe. Most of the time, for most people, it functions exactly as advertised. But the safety of the system is not your safety. It is the safety of the system when they align good. When they don't, the system chooses itself every time. Because that is what systems do, not out of malice, out of structure. On December 1st, 2001, Argentines woke up in the same country with the same money in their accounts, the same bank on the corner. The rules had changed overnight. The money hadn't gone anywhere, only the access had, and that was enough. If tomorrow morning you opened the news and saw that temporary restrictions on cash withdrawals had been introduced, what if everything you have right now would still truly be yours? Not on paper, not in the system. Think about it before it becomes urgent.